right now isn't just a corporate headline, a tech development, or a political maneuver. It's all three colliding in a way that could reshape global trade and business strategy for decades. This isn't a routine policy shift or another chapter in the US-China trade war. It's an unprecedented arrangement that's forcing analysts, investors, and policymakers to rethink how Washington interacts with some of its most powerful corporations. If you've been watching the chip shortage drama, the US-China tech rivalry, or the rapid rise of artificial intelligence, this is a development you can't afford to ignore. It involves two of the world's most critical semiconductor companies, Nvidia and AMD, and a brand new type of deal that could become a blueprint for US industrial policy going forward. Here's the headline. The Trump administration has struck an agreement requiring Nvidia and AMD to hand over 15% of all revenue from their AI chip sales to China directly to the US government. In exchange, Washington is granting them the export licenses needed to sell in that massive market. We're not talking about a one-time tariff, a fixed licensing fee, or a standard corporate tax. This is an ongoing revenue-sharing agreement directly tied to specific sales in one of the most strategically sensitive industries in the world. According to Reuters, the Wall Street Journal, and the Financial Times, nothing like this has ever happened before in modern U.S. trade history. The chips in question are Nvidia's H20 AI processor and AMD's MI308, both designed to comply with earlier U.S. restrictions while still catering to China's booming AI industry. Under the terms, every time one of these chips is sold to a Chinese customer, 15% of the sale price flows straight to Washington. The numbers are staggering. Nvidia's annual revenue from China alone can reach tens of billions of dollars. If just one product line moves $15 billion in a year, that's over $2 billion heading to the US Treasury from Nvidia alone. Add AMD sales, and the government could be collecting billions annually from a single policy decision. Yet here's the kicker. Officials haven't decided exactly how the money will be used. Will it go to the general budget, be earmarked for national security projects, fund infrastructure, or be spent on politically sensitive programs that could stir controversy? The lack of clarity is already fueling speculation. Critics are calling it a form of corporate toll-taking, a pay-to-play model where market access depends on paying the government a slice of your profits. Without transparency, they warn, the potential for political favoritism or misuse is obvious. Supporters counter that if U.S. companies are profiting from selling sensitive tech to a strategic competitor, taxpayers deserve a cut, and that this arrangement strikes a balance between national security and business opportunity. What makes this even more striking is how much it resembles policies more common in centralized economies. In China, Russia, and Vietnam, it's routine for companies in strategic sectors to give the state a share of their revenue, appoint government-approved executives, or directly fund state projects. The United States, by contrast, has historically avoided such direct economic entanglements with private companies, especially on an ongoing basis. By linking export approval to a fixed share of sales, Washington is breaking with its own long-standing free market traditions. That's why many analysts see this as a test case for a more interventionist approach to U.S. capitalism. And if it works, the implications could spread far beyond semiconductors. Imagine similar revenue-sharing arrangements for aircraft exports, pharmaceutical sales, or defense contracts. The playbook would fundamentally change how American corporations plan their global strategies. There's also a strategic gamble at play. The administration is betting that Chinese buyers will continue to choose Nvidia and AMD products even with the 15% surcharge because of their performance advantage. But Beijing is already pouring billions into its own chip industry, aiming to replace foreign components with domestic ones. If this revenue-sharing rule accelerates that push, U.S. companies could eventually lose a massive market entirely. It's not just Nvidia and AMD under scrutiny. Intel has already been summoned to the White House for talks. Such meetings often produce symbolic commitments, building U.S. factories, increasing domestic hiring. But if this new deal becomes standard, Intel and other giants may face the same 15% demand. Geopolitically, the move sends a mixed signal. On one hand, it reinforces the U.S. stance that cutting-edge tech comes with strings attached, especially for rivals like China. On the other, it risks making Washington look like it's adopting the very tactics it has long criticized in others, undermining its credibility in future trade disputes. Domestically, the reaction has split along familiar political lines. Proponents frame it as a clever way to ensure national benefit from the sale of critical technologies. Opponents call it government overreach, a precedent that could be exploited for partisan gain. The echoes of political extortion are hard to ignore. Economically, the impact will depend entirely on execution. If the billions collected are invested in shoring up supply chains, advancing U.S. semiconductor R&D, or strengthening infrastructure, it could enhance America's long-term competitiveness. If they vanish into opaque projects or politically driven spending, the backlash will be swift. The reality is, this arrangement marks a new kind of stress test for the relationship between the U.S. government and its most influential corporations. For decades, companies operated abroad under the assumption that their obligations to Washington ended with standard taxes. Now, at least in some industries, the rules have changed. This is a turning point. The first time this deal happens, it's a shock. The second time, it's a trend. And once it's a trend, it's policy. The kind of policy that can reshape corporate decision-making for an entire generation. At stake is not just whether Nvidia and AMD make a little less profit this year. It's about whether the United States is shifting toward a more transactional, state-linked form of capitalism, one that ties government revenue directly to corporate profits in specific markets. It's about whether America's competitive advantage is sharpened or blunted by such policies. And it's about whether Washington will hold fast to the free market principles it has long championed or adapt to the more interventionist strategies it once opposed. Nvidia and AMD have made their choice. The real question is, who's next? And what will this mean for the balance of power between governments and the tech titans shaping the future? The story isn't over, far from it. If this becomes the model, we may be watching the birth of a new global business order, one where politics and profit are inseparable, and every deal comes with a cut for the state.